Most people think they have time when a bank starts to wobble. They think that there will be warnings, headlines, maybe a few weeks to figure it out, but that is not how this works. You see, the real danger is finding out too late that part of your money was never protected to begin with. Watch this closely, because what matters most in a banking panic is not what you believe is covered, it's what actually is.
Do this before your bank fails. A step-by-step walkthrough. In my last video, I told you about Mike, a restaurant owner in Chicago with $50,000 sitting uninsured in an account he'd never thought twice about. Today, I'm walking through exactly what Mike did about it, step by step, so you can do the same thing today. Mike owns a small restaurant. $300,000 in one checking account. Payroll every 2 weeks. Rent on the first. Suppliers on net 30. Everything runs through that one account. After watching that video, Mike did something most people never do. He spent 2 hours actually looking at his situation. This is what he found and what he did next. Follow along, because your numbers might look exactly like his. Step 1. Mike went to FDIC.gov, clicked Bank Find Suite, typed his bank's name. Free, public, 3 minutes to find your institution. No login, no account, nothing to sign up for. Mike's bank came back with a capital ratio of 6.2%. Technically above the regulatory minimum, but barely. The FDIC flags anything under 8% as worth watching. Mike's bank was sitting 2 points below that threshold. Then he looked at the loan breakdown. Commercial real estate concentration, 61% of total loans. For every $10 his bank lent out, $6 went into office buildings, retail spaces, and apartment complexes. 3 of those property types in his area have had rising vacancy rates for 2 years straight. Mike didn't panic, but he kept going. Because knowing is always better than not knowing. Step 2. Mike looked up his actual FDIC coverage. And this is where most people get it wrong, including him. The limit is $250,000 per depositor, per institution, per account ownership category. His personal checking covered up to $250,000. His personal savings, another $250,000. Those are separate categories. But his business account operates under its own category, $250,000 total, not per owner, per account. Mike had $300,000 in that business account. $50,000 was completely uninsured. If his bank got a Friday night letter, that $50,000 was not legally guaranteed to come back. Mike sat with that for a minute. Then he moved to step 3. Step 3, Mike called his accountant. Not in a panic, just one question. Is there a smarter way to structure this? His accountant told him something most business owners don't know. You can open an operating account at a second institution. Move the excess above the limit there. Both accounts become fully covered. Simple, legal, takes a week. Mike also learned that joint accounts work differently. Add a spouse or co-owner, coverage doubles to $500,000 at that institution. Not applicable to his business account, but immediately useful on the personal side, where he and his wife were also sitting above the limit combined.
Hey, sorry to jump in, but if you would like to take advantage of the changing times and the real estate cycles as these issues happen in the banking system, and they get worse and lending starts to slow down or cease completely, I put together a bundle of 4 courses. It teaches you real estate cycles, where we are in the cycle, how to buy homes that are under distress, how to market them and sell them and make a lot of money doing it. Links down below to all 4 for a crazy low price. Now let's dive right back into this video.
Step 4. Mike looked at what to do with operating reserves he didn't need immediate daily access to. Treasury money market funds, backed directly by the US government, not by a bank's loan book, not insured by the FDIC, because they don't need to be. Mike moved 60 days of operating reserves there, still liquid, still accessible within a business day, just not sitting inside a bank balance sheet exposed to commercial real estate defaults. Before I go further, this is not financial advice. I'm not Mike's advisor. I'm walking you through what he did. Your situation is different. Talk to a professional about your specific numbers. But here's what Mike knew after 2 hours that he didn't know that morning. He knew his bank's capital ratio. He knew exactly which dollars were exposed. He knew how to fix it. 2 hours, one Tuesday afternoon, done. No financial advisor required to start. Now here's why the timing matters right now, not 6 months from now, right now. $1 trillion in commercial real estate loans are maturing this year. Banks that lent into office buildings and retail space are watching borrowers struggle to refinance at today's rates. When those loans go bad, the losses land directly on bank balance sheets. And some of those balance sheets are already thin. Dime Community Bank, 602% commercial real estate exposure relative to their equity. Flagstar, over 500%. New York Community Bancorp, already junk rated by Moody's. These are public numbers. You can find them yourself on FDIC.gov in the same search Mike used. The people who got hurt at Silicon Valley Bank weren't reckless. They just didn't know the rules before they needed them. They didn't know 1/3 of American deposits sit above the insured limit. They didn't know business accounts are capped differently. They didn't know to spread. On a Thursday in March 2023, they found out the hard way. 11 employees. Monday morning, no paycheck. So here are the 4 steps. Write them down. 1, go to FDIC.gov, click Bank Find Suite, search your bank, check the capital ratio and commercial real estate concentration. 2, calculate your actual coverage. Personal and savings are separate categories. Business accounts have their own cap. Joint accounts double the limit. 3, if anything sits above $250,000 in a single account category, open a second account at a second institution and move the excess. 4, consider moving reserves you don't need daily access to into treasury-backed money market funds outside the banking system entirely. That's it. That's what Mike did. His bank hasn't failed. Maybe it won't. But Mike knows exactly where he stands. And that's the difference between a Saturday morning problem and a Saturday morning plan. If this helped you, drop a comment and share it with one business owner you know. A landlord, a contractor, anyone running payroll through a single account they've never looked twice at. The FDIC site is free. The information is public. The only thing between you and knowing is whether you look today or wait for a Friday night to make you.